Here is something almost nobody tells you about a Roth. The money you put in has already been taxed. So when it comes out in retirement and it qualifies, it comes out clean. And that same account can hold a lot more than two index funds, real estate, private notes, precious metals, private companies, same Roth tax treatment, a much wider menu of what you are allowed to hold. Stick with me because near the end, I'm going to show you the one feature a self-directed Roth has that a traditional IRA does not. And for a lot of people, it is the whole reason they pick a Roth in the first place. I am Austin with Mountain West IRA. We are an administrator for self-directed accounts. So my job today is simple. Walk you through how the rules work, not what to buy, not what is smart for you, just how the machine actually runs. Quick note before we start. Nothing here is investment, tax, or legal advice. Check with your own financial advisor about your specific situation. Let us get into it. Let me clear up the biggest mix-up first. There is no separate account at the IRS called a self-directed Roth. Under the hood, it is a regular Roth IRA. The thing that makes it self-directed is where you hold it, an administrator that lets you direct the account into a broader set of assets instead of a short fund menu. So every Roth rule you already know still applies. Here's the short version of how a Roth works and how it differs from the traditional account a lot of people are used to. With a traditional IRA, the money usually goes in before tax and gets taxed on the way out. A Roth flips the timing. You fund it with dollars you have already paid tax on. The account grows with the tax deferred, and qualified money comes out tax-free in retirement. Two phrases matter for the tax-free part, and people skip right past them. First, age 59 and a half. Second, the 5-year rule, which means the account has to have been open at least 5 tax years. Hit both, and qualified withdrawals, including the growth, come out without federal tax. One more Roth-only feature that surprises people. Your contributions, the dollars you put in, come back out at any time, tax-free and penalty-free. That is because you already paid tax on them. The earnings are the part with the rules. The contributions are not locked the way a lot of folks assume. Keep that distinction in your head. Contributions and earnings get treated differently. It comes up again later. Here is where the Roth has a gate the traditional account does not. A traditional IRA has no income cap on whether you can contribute, only on whether the contribution is deductible. A Roth has an income limit on the contribution itself. Let me give you the 2026 numbers. The contribution limit for the year is $7,500. If you are 50 and older, there is a catch-up that brings it up to $8,600. Now, the income piece. And this is based on what is called MAGI, Modified Adjusted Gross Income. If you file single, you can make the full contribution under $153,000. Between $153,000 and $168,000, it phases down. Above $168,000, the direct contribution goes to zero. Married, filing jointly, the full contribution runs under $242,000. Phases down between $242,000 and $252,000. Above $252,000, the direct contribution is gone. And the deadline is friendlier than people expect. You have until the tax filing deadline of the following year. For 2026 contributions, that is April 15th, 2027. So what happens if you earn too much to contribute directly? This is where you hear the term backdoor Roth. The short, honest version. Someone over the income line contributes to a traditional IRA, which has no income cap on contributions, and then converts that into a Roth. The conversion has no income limit at all. Here's the catch nobody mentions on the highlighted reel. The pro rata rule. If you already hold pre-tax dollars in any traditional, SEP, or simple IRA, the IRS does not let you cherry pick only the after-tax dollars to convert. It treats the conversion as a proportional slice of all of it, and part of the conversion can become taxable. That is a real conversation to have with your own tax advisor before you move a dollar. I am walking you through how this works, not telling you to do it. The mechanics are the point. This is the part most people have never been shown. Inside a self-directed Roth, you are not limited to a fund list. You direct the account, and the account can hold a much wider range of assets. The kinds of options people hold in a self-directed Roth include real estate, like a rental property or raw land, with the account as the owner. Private notes and lending, where the Roth is the lender. Precious metals that meet the IRS purity standards, held the approved way. Private companies and certain private offerings. Notice what I am doing and what I am not. I am describing what is possible inside the rules. I am not recommending any assets, and I am not telling you any of these is right for you. Which assets fit your situation is a question for you and your own advisor. Here's why people pair the self-directed angle with a Roth specifically. The Roth is a tax-free when qualified bucket. So if an asset grows over a long time inside it, that growth, when the withdrawal qualifies, is not taxed. That is the appeal. You are choosing the wrapper on purpose. Now, the guardrails, because this is where the account gets into trouble, and the rules are not optional. These are the prohibited transaction rules, and they exist to keep the account at arm's length from you personally. Start with the idea of a disqualified person. That is you, your spouse, your parents and grandparents, your kids and grandkids, and certain entities tied to them. The account cannot do business with these people. So, the Roth cannot buy something you already own, and it cannot sell to you. You cannot live or vacation in a property the Roth holds, not even one night. You cannot pay yourself to fix up a Roth-owned property. No sweat equity. No swinging the hammer yourself. Family members who are disqualified cannot use the asset either. Principle underneath all of it. The account is for the account's benefit, not for your use today. Break a prohibited transaction rule, and the consequences are severe, up to the account losing its status. This is the number one reason to keep an administrator and your own advisor in the loop before you act. Mechanically, this is simpler than people fear. There are three common ways money gets into a Roth: a direct contribution within the limits we covered, a transfer from another Roth, or a conversion from a pre-tax account, which is a taxable event in the year you do it. When the account buys an asset, title and money run through the Roth, never through you personally. The account writes the check, the account is on title, income from the asset flows back into the account, and expenses get paid from the account. That clean separation is what keeps it compliant. Here's the feature I promised at the top, the one a traditional IRA does not give you: require minimum distributions. With a traditional IRA, once you hit the trigger age, currently 73, the IRS makes you start pulling money out every year, whether you want to or not. A Roth IRA has no required minimum distributions during the original owner's life. Think about what that means when the account holds something that does not split easily, like a piece of real estate. With a traditional account, an RMD year can force an awkward scramble for cash to satisfy the distribution. The Roth does not put you in that spot. You are not forced to sell or distribute the asset on the government schedule. For a lot of people, holding a long-term, hard-to-divide asset, that single difference is the reason they choose the Roth. Here are some frequently asked questions. Can I really hold real estate in a Roth? Yes, the rules allow the account to hold real estate. The account owns it, the account collects the rent, the account pays the bills, and you stay at arm's length the whole time. If I earn too much, am I shut out? Not necessarily. The direct contribution has the income gate we covered, but a conversion has no income limit. That is the backdoor route, and the prorated rule is the part to map out with your tax advisor first. When can I take the growth out tax-free? When the withdrawal qualifies, which generally means age 59 and a half, and the 5-year rule has been met. Your contributions separately can come out anytime, tax-free and penalty-free. Do I ever have to take money out? Not as the original owner. A Roth has no required minimum distributions during your lifetime, which is one of the biggest differences from a traditional. Can my kid have one? If a child has earned income, a custodial Roth is possible, funded up to what they have earned. That is a long runway of tax-deferred growth. The mechanics are worth a real conversation. So, that is the self-directed Roth, start to finish. After tax dollars in, a wide menu of what you can hold, strict rules that keep the account at arm's length, and no forced withdrawals during your lifetime. If you want to understand how any of this maps to your own picture, that is exactly what our team is here for. We help people open and run these accounts as the administrator. We do not give advice on what to hold. And one more time, because it matters. Nothing in this video is investment, tax, or legal advice. Check with your own financial advisor about your specific situation. I am Austin with Mountain West IRA. Thanks for